Welcome everyone to your first explainer for ACCT 428, Financial Statements Analysis. My name is Dr. Emad Awadallah, and over the next few minutes, we are going to lay down the absolute bedrock for this entire course. If you can really get a handle on this, you'll be well on your way to a powerful future in finance. So here's our game plan. We'll kick things off with the big why, the whole purpose of analysis. Then we'll look at the primary tools an analyst has. After that, we are going to tackle a huge concept, the idea that profit is not cash. From there, we'll see how to gauge a company's financial health, and finally, we'll talk about where to find the complete story behind the numbers.
All right, let's jump right in with that first big question. Why even bother? Why do we spend so much time digging through all these numbers and reports? What is financial analysis really all about?
Well, at its core, financial analysis is all about context. It's not just looking at numbers in a vacuum. It's about understanding how a company is doing relative to its industry and within the broader economy. And the whole point is to make a smart decision or a recommendation, which, usually has to do with providing a company with capital.
Now that capital really comes in two main flavors. If you're providing debt, you're basically a lender. Your main concern is pretty straightforward. Am I going to get paid my interest, and will I get my original loan back? But if you're providing equity, you're an owner. Now you're asking a totally different set of questions, like, is this company going to grow? Is it going to pay dividends? And is my piece of the pie going to become more valuable?
But here's the thing. It doesn't matter if you're a lender or an owner. It all boils down to this one incredibly powerful concept. Can the company earn a return on the money it's using that is higher than what that money cost them in the first place? If it can, it's creating value. If it can't, well, it's destroying it. It's really that simple.
Okay, so that's the goal, but how do we actually figure that out? To see if a company is creating value, we need information, we need tools. So let's take a look at what's in our toolkit as analysts.
Our starting point, our bread and butter, is always the company's financial reports. This isn't just one document, it's a whole package. You've got the audited statements, other required disclosures, and really importantly, commentary from management. And believe it or not, from this information, we make massive economic decisions, like whether to invest, who to acquire, or if a company is even worthy of a loan.
And this brings us to a really important distinction. Think of financial reporting as looking in the rearview mirror. It's telling you what's already happened. But financial analysis, well, that's about using that rearview mirror to look at the road ahead. We evaluate the past, sure, but we do it to understand the present and, most critically, to predict what might happen in the future.
So when we get down to it, our analysis really zeroes in on three big themes. First up is profitability. Can this company actually make a profit? Second is cash flow. Can it generate cold, hard cash? And third is risk. What could possibly go wrong and jeopardize its future?
I want to double-click on that second theme, cash flow, because it brings us to what might be the single most important lesson in all of finance. Profit is not the same as cash. And to really get why, let's walk through a quick story about a fictional company called Doha Designs.
Okay, so picture this. Doha Designs is a brand new furniture business, and it's their very first month. They make $2.5 million in sales, and customers pay them in cash right away. Great. Now, to make those sales, they had to buy $1.5 million worth of furniture, but they did it on credit, so they haven't paid their supplier yet. And finally, they paid out $200,000 in cash for things like rent and salaries.
All right, so based on just those facts, take a second. How much profit do you think Doha Designs made in December?
If you said 800,000 riyals, you are spot on. We take the revenue, that 2.5 million, and we subtract all the costs associated with generating that revenue. So that's the 1.5 million for the furniture and the 200,000 for rent and salaries. This is what accountants call the matching principle. You match the expenses to the revenues regardless of when the cash actually changed hands.
But here's the kicker. Does an $800,000 profit mean that the company's bank account actually went up by $800,000? Let's take a look at the actual cash situation.
Whoa, not even close. Their cash flow was a whopping 2.3 million riyals. So what gives? Well, think about it. They had 2.5 million in cash come in from sales, but only 200,000 in cash went out. They still haven't paid that 1.5 million bill for the furniture yet. That cash is still sitting in their bank account.
And this table just makes it crystal clear. In December, you see that huge gap, 800,000 in profit, but 2.3 million in cash flow. But now look at January. Let's say business is exactly the same, so the profit is still 800,000.
But the cash flow takes a nosedive because now they finally have to pay that $1.5 million bill from December. This is the power and the danger of timing.
And that simple story perfectly illustrates why, as analysts, we have to look past the profit number. There's an old saying in finance, profit is an opinion, cash is a fact, and it's absolutely true.
You see, positive cash flow is literally the lifeblood of a company. It's what keeps the lights on, what lets you pay your employees, what we call being a going concern. It's the money you use to invest in new projects, to jump on unexpected opportunities, and of course, to actually pay back your investors.
And this idea of being able to pay your bills brings us to two more critical terms, liquidity and solvency. Liquidity is all about the short term. Can you pay the bills that are due next week, next month? Solvency, on the other hand, is the long game. Can you meet your obligations years down the road, like paying off a big loan?
So we know we need to assess all these things: profitability, cash, liquidity, solvency. But where in the world do we find all this information to get the complete story?
Well, a good analysis is like using a zoom lens. You start wide by looking at the overall economy and the specific industry. Then you zoom in on the company itself. And just as important, you look at its peers, its competitors, to see how it stacks up. When we zoom in on the company, the heart of our information is the complete set of financial statements. This means the income statement, which tells us about profit, the balance sheet, which is a snapshot of financial health, the statement of changes in equity, tracking the owner's investment, and of course, the statement of cash flows. And please never ever forget the notes to the financial statements. That's where all the juicy details are hiding.
But even then, the numbers alone don't tell the whole story. If the statements are the what, then all this supplementary information is the why. This is where you get the narrative from management, the opinion from the auditors. This is where you find the context that brings those numbers to life.
So there you have it, the why, the what, and the where of financial analysis. If you take one thing away from this, let it be this. Profit is an accounting concept, but cash is the reality that keeps a company breathing. You now have the essential framework that we're going to build on for the rest of the course. Thanks for tuning in, and I'll see you in Part B.